So if you really start to look at what businesses earn, what's an appropriate return on capital, and then you start thinking about what the cost of borrowing is today, that's how I get to this negative number. You're getting paid. If you can make 6% in your business, but you can borrow for 3%, I mean, the Fed is doing everything humanly possible to liquefy this economy, to push this economy forward. And it's admirable that they're doing it, and it's the mistake that was made in the Great Depression. And I truly believe that we wouldn't be sitting in an economy that's performing as well as it is. I'm not saying it's performing well, I'm saying performing as well as it is, had it not been for the Fed's actions to get us to this point. The question, though, is, has the Fed gone too far? And what will happen? What will be to your question before, what will happen when the Fed starts to rewind? Some of the other things that may happen, I don't like to focus on these things, but they do have an impact. If Europe blows up, if there's some conflagration in an international place, we could actually see interest rates start to rise. There's a competing theory that if Europe calms down, if Europe fixes its problems, if the world suddenly finds peace, well, all the money that's come here to the United States that's bought all these bonds is going to leave the United States and go to places where they can get an appropriate return. You can buy Spanish bonds today, 7% return, 8% return. The same bond in the United States is paying 1.25%. So if we found that the European Union could actually figure out its issues, we may actually see money leave and flee the United States to go to other economies because interest rates are much, much higher in places like Spain and other parts of Europe. And so this could actually start to go in reverse, and that will have a dramatic impact on the economy. So some of the other threats that we look at, and I don't think are fully understood by businesses today, or at least I know if I wasn't a banker, I certainly wouldn't be reading about things called Basel III. So there's an international capital standard that's been floating around the globe to create a capital requirement for banks. And there was a Basel I, there was a Basel II. The United States adopted Basel I, never adopted Basel II, which coincidentally, Basel II wanted to lower the capital standards for banks. This is pre-crash. But Basel III now puts in place these onerous capital standards for all banks across the globe. And the United States has decided that we're going to sign this accord. The interesting thing, though, usually these accords just relate to the largest institutions in the country and systemically important institutions. This time around, they said, nah, we're going to have all banks have this applied to. So there's been this huge outpouring in the community bank space to try to fight this implementation. But what does it mean to you? What it means to you is that every bank across this country is going to be held to the same capital standard. So our bank has its market mostly in the Northern Jersey, New York City market, is going to have the same capital standard as Bank of America, JP Morgan Chase, and Citibank. Just that statement by itself doesn't sound right. I don't care who you are, and I don't care what political persuasion you may be, the whole thing just doesn't make sense. And so what does that mean to you? Well, what it means to you is banks are going to have to hold more capital and therefore will not be able to make as many loans. And also within the standard itself, they've created these risk weightings about certain types of assets. So things like interest-only mortgages are going to be risk weighted significantly higher than any other loan. Construction loans are going to be risk weighted significantly higher than other types of loans. They're going to delve into the home mortgage finance business, and right now there's one risk weighting. All residential mortgages are risk weighted at a certain level. Now there's going to be 4 or 5 risk weightings. And so what I believe is going to happen is that the Fed is going to actually start to sculpt behavior at banks, and they're going to shun certain types of assets, and they're going to model how the economy moves. And that's important for everybody in this room to understand that may in fact happen. Now, the community bankers are fighting back very, very hard. We're going to know in a couple of weeks whether or not we've been effective to get some carve-outs here. But you've all heard of Dodd-Frank. You've all heard of this, great financial legislation that's supposed to solve too big to fail, except for one problem, right? All the too big to fail have gotten bigger and they're still here. But that's put a tremendous amount of burden on banks like ours. And burden, when I think about burden, I think about, okay, it's a problem for us as bankers, but burden to you means it's costing us more to do our business, and therefore we're going to have to pass that cost on. And the only way we can pass that cost on is to raise interest rates and drive fees higher. Now, I think everyone here has read over the last year or two since the implementation of Dodd-Frank, many banks have given up on free checking, debit interchange fees have gone through the roof, small business owners are getting crushed in the way that, they have to pay for Visa card, MasterCard. All the fee structures of all the banks have changed dramatically. There's a pressure here to drive away certain types of business from the banks and create higher capital needs. And so as we drive up these capital needs, banks are going to be able to make less loans. Again, I keep driving back to the same point, and that is, I think you really need to know who's your banker, what type of bank you should be doing business with, and what type of relationship you're going to have, because most bankers aren't going to come and sit and talk to you about their internal problems. They're just going to lay out their business plan, and they're going to say your business works and yours doesn't. And you need to understand what's happening in the financial space to be able to determine how you're going to run your business going forward. And this relationship, I think, is going to come back into vogue. The entire field of banking is going to change dramatically. There are something like, I don't know, I forget the exact number, but it's, I want to say it's 69 or 70,000 bank branches in the country. As these banks shrink in size, they're not only going to shrink in size, we're going to shrink the number of bank branches, because what's going to happen is as capital standards go up and banks are being forced to more efficiently use that capital, they're going to determine very, very quickly that the only way to offset their income is going to be to drive down their expenses. And one of the greatest expenses at banks are branches. And I don't know about anybody in this room here today, but the vast majority of the business clients that we do business with today no longer walk into a physical branch. They use online banking, they use mobile bill pay, they use remote deposit capture, they're using electronic services. And so the whole face of business banking, never mind the Gen Y or Gen X generation that's, has never walked into a bank and will never walk into a bank. I kid all the time, my kids, if it wasn't for the fact that I had an office in the bank, they'd never know what the inside of a bank would look like, right? They go online, they find the bank they like, they sign up, they get, mobile bill pay, they get and they do everything. They get direct deposit. My kids, I have to force my kids to keep a $20 bill in their wallet, God forbid, for an emergency, but because they do everything by debit card and credit card. But think about what that means going forward. Think about the world where we have a lot less banks than where we have today. Less availability to get to a bank physically, so less people sort of interfacing with you. And I think that draws a picture of how, what's going to happen in the economy. Our economy, one of the great things about the U.S. economy has been the diversity that's been provided for in the financial system. We're one of the few, I don't know if anybody realizes this or not, but we're one of the few countries in the world that have a very diverse banking population. Most countries in the world have a couple of state banks and a couple of other banks that are cousins of the state bank. So you look at even Canada. Canada has 5 banks. Spain has 4 or 5 banks. I think Germany may have somewhat, not similar, but they do have more banks. But most of the modern world only has a couple of banks, and some other countries have just one bank. It's the country's bank, and that's it. So part of the diversity that is important here in the United States has come from this diversity in financial services, and the vast majority of small business owners use some form of leverage to capitalize their business, and that's been provided mostly by the smaller community banks. So if we're headed in the direction where we're going to have less of those and maybe more of the too big to fail institutions who are even bigger, I'm not sure what that means, for anyone in this room and how they use leverage in their businesses. So I think someone asked me, or was going to ask me, something about the election. Does that matter? And what will that do? And again, I'm not an economist, but and I really don't want to get into politics, but what I will tell you is, as it relates to the conversation we just had, I don't think the election is going to matter at all. And the Federal Reserve is an autonomous body, and its mission is to drive the unemployment rate down as much as it can and to provide for a stable currency. And so it will continue to do what it's doing for the foreseeable future. And the foreseeable future looks to me like one of two different scenarios. We've modeled this at our bank because we have to make interest rate bets, or we take risk on the direction of interest rates and how we run our business. And so the two models we track are a gradually recovering economy is scenario one, and it's the one I would tell you I follow. And so if we look at the last, 18 months or so, we are seeing through our clients that recovery. We are seeing businesses doing better. We've seen a lot of people in 2009, 2010, do all the draconian cutting, get more efficient, and now we're starting to see the benefits of those cuts. Now, not so good for the people who got cut, but for the businesses themselves, they were very smart. Most of them took the tough medicine, put themselves in a good position, and are now growing and doing much better. We're seeing financial statements from the vast majority of our clients. 2011 financial statements are significantly better than 2010, and we suspect 2012 will be even better than 2011. So there's clearly a healing going on in the economy. We're seeing, although unemployment is, I don't even know what unemployment is or is supposed to be, it depends on what metric you use. The one you see in the newspaper is just unemployment. That's U3, I think it is. That's at 7.8% or so. The one I watch, the one that I care the most about is U6, and that's at about 15%, and that's come down from almost 20%. And that's all people that are available to work, that can work. That number keeps coming down, but there's an interesting thing that I'm hearing from all our business owners, and that is that even with what we consider to be high unemployment, we can't find people to work for us. And it's a constant refrain. I'm hearing it all over. And as a matter of fact, I think there's actually an article today in the Wall Street Journal about it. But we're hearing it from all the people on the street. So as high as unemployment may or may not be, we can't find qualified people to come to work for us. So I'm not really sure what that means, and I'm not sure what we need to do about it. But clearly, there's a disconnect between those who are looking for work, the work that's available, and the amount of training or the amount of education that we're providing to be able to train future workers. So in this gradual recovery scenario, I think it's yes, I'm sorry. So in the gradual recovery scenario, we see another couple of years of pretty much where we are today. We see gradual recovery. We see interest rates beginning to moderate in 2014. By the way, the Federal Reserve, you've heard me mention them a few times here, they're an interesting body. I like to say they have perfect knowledge. And what I mean by that is, it's not that they're oracles or anything, but every input of this country comes back to the Federal Reserve and globally. So they get to see things none of us are able to see. They get data feeds from every single corner of the universe. And they're able to look at all of that and make decisions. Doesn't mean they're always right, but they have perfect information. And so when you read the headlines in the newspapers and, things are going great, things aren't going great, the economy stinks, the economy's great, whatever it is the headline reads, I always go to the Federal Reserve website and I want to see what they're saying at their FOMC meetings. Because those guys, those 11, 14, 15 FOMC members are sitting in a room with perfect information and making decisions about the economy. I think I'm more willing to bet on their read of what's going on than some newspaper reporter. And if you listen to the FOMC and if you watch their actions, they're saying we're in a very sick economy. And they don't believe that the economy is getting significantly better. Locally here, I believe we seem to be in a little bit better part of the country. And so I take that information and I factor in what we see in our business because we have 4,000 feeds giving us information. And I would tell you that sitting here locally, our economy looks a little bit better than what the newspapers would have you believe. And I believe the unemployment rate is actually significantly lower in our market for our clients than it is on the national average. And I would tell you that I think this is a great time because of where interest rates are, the lack of competition in some markets and areas. This is a great time to be wherever we are, whatever we're doing. It's a great time to sort of step back, look at what's happening in the environment around you. This is a phenomenal time to bring on new business, to take on a new line, to merge with a competitor, to do any of the things that you want to do, buy the building you wanted to own. I believe asset appreciation is something that has to occur in the future. Again, if we look at this negative interest rate scenario, if you look at other points in history where interest rates have been close to the bottom or very, very low, you will find that they were followed by rapid asset appreciation after, otherwise known as inflation. Now, the Fed is committed to squash out inflation and says it won't let it happen. I'm not sure it's going to be able to accomplish that. But even mild inflation, which I do believe the Fed wants to introduce into the economy, would mean higher property values, higher asset values, would start to mean that cash flows would be valued at a higher rate than they are today. And so all of that's good news, but you got to act today, because by the time it makes itself apparent, I don't want to say it's too late, but a lot of it will have run its course.